Welcome to the Undercurrent, your source for independent, on-the-ground reporting. I'm Lauren Windsor. Last week, I went to New York for the Cato Summit on Financial Regulation, or what really should have been called the Cato Summit on Financial Deregulation. You see, the Cato Institute is the Koch brothers-funded libertarian think tank that develops much of the intellectual ammunition for GOP deregulatory policy. The event featured Commodities Futures Trading Commissioner Christopher Giancarlo and Securities and Exchange Commissioner Michael Piwowar, alongside Cato economists who advocated abolishing Dodd Frank financial regulation, the Federal Reserve, and FDIC deposit insurance. Yes, deposit insurance. That thing that protects you and the vast majority of banking consumers from losing all your money in the event of a bank run or failure. But George Selgin, the director of Cato Center for Monetary and Financial Alternatives, loves bank runs.
But the whole story of bank runs is really quite ridiculous. The truth of the matter is that most of the time when there are runs on banks, the runs are on banks that are already in trouble. When Northern Rock was run upon in England, and it was no coincidence that it wasn't just picked out randomly from the herd. It was a bad bank, and people were acting in a way that was quite desirable, really. Of course, some of them might not have gotten their money, but the bank would have been closed, and from the social point of view, that's what you want. Runs are great. They really actually are.
Yes, great. Despite what happened to people during the Great Depression and the 2008 meltdown, and what may happen yet in Greece and the Eurozone. Talk to me about George Selgin's comments about the FDIC, that we should eliminate deposit insurance and that bank runs are a good thing.
Well, first of all, I give Mr. Selgin credit for acknowledging that there's trillions and trillions of dollars in public support to the banking system through deposit insurance. Not surprisingly, a lot of the people who own the banks want to have their cake and eat it too. They want to be deregulated and keep that deposit insurance. The fact that we have this public backstop for the banking system is really one of the things that makes a very strict level of regulation of banking necessary. With that said, though, I think his idea of just removing deposit insurance is really a terrible idea, one that would have a very negative effect on people's ability to get the convenience of the banking system and to have the security of knowing that their money is protected in the banking system. And without that security, people would be on the line to try to investigate the very complex financial transactions of the banks that they put their money into.
Investopedia defines speculation as the act of trading in an asset or conducting a financial transaction that has a significant risk of losing most or all of the initial outlay in expectation of a substantial gain. Many economists point to over-speculation as a cause of the 2008 financial meltdown. Commissioner Giancarlo, though, says otherwise.
Would you advocate not having limits on speculation, only on manipulation? Like, you would, any amount of speculation is okay to you, so long as it's not manipulative. Like, at what point does it cross the line?
Don't. That may be what you heard me say. What I've said with regard to speculation is that it needs to be data-based. So we at the CFTC, before we put limits on speculation, have to have real data that shows the role of speculators and excessive speculators, and based upon that data, if appropriate, put a limit in place. And we've been looking at this for a year, and we still don't have any data showing harm to the market by excessive speculators. We have data showing market manipulation, and we have been active in many cases, not in all cases, at taking steps against manipulation. We need to be very vigilant in the area of manipulation. Until I see real data of the role of excess, not narratives, but real data of a harmful impact on markets by excessive speculation, then I won't support a position limit until I see the data and it's demonstrable that there is a harm cost to the markets.
But so you wouldn't say that there was data coming out of the 2008 financial meltdown that demonstrably showed that excessive speculation occurred to create that market failure?
I haven't seen that. You asked me about the 2008 financial crisis.
Yeah.
What did I think? It's less important what I think. What's more important what Congress thinks. coming out of the 2008 crisis, Congress could have banned speculation. It could have had it made a judgment that the crisis
banned speculation.
But could have come to a judgment that the crisis was caused by excessive speculation. It did not.
CFTC Commissioner Chris Giancarlo said that 2008 was not caused by over-speculation. Do you agree or disagree with that?
Well, it's all in what you mean by speculation, of course, but there were a lot of things in the financial crisis that were tied to, I think, broadly speaking, financial speculation. In the summer of 2008, the price of crude oil went up to over $140 a barrel, which put tremendous stress on the U.S. economy. And I think a big reason for that was the flood of speculative money into the oil markets. And then when the recession hit, it went down in just a couple months. The price declined by 2/3, from over $140 to less than $50 a barrel. Then it zoomed back up to $100 a barrel. Now it's down at $60 a barrel. And it really seems like a speculative interest in these commodity markets was a big driver of these wild price swings and put a lot of stress on ordinary Americans and on the economy. And because of that, in Dodd Frank, Congress called for limits on speculation in commodity markets. Congress also did look at the problem of speculation on Wall Street in general, and of course put in place the Volcker Rule. That the Volcker Rule doesn't use the term speculation, but it basically says that banks who are using insured deposits, money that's backed up by the public, cannot do what's called proprietary trading, which means trading for their own account like a hedge fund would. That was something that Congress decided, that that proprietary trading role of banks, that ability to do sort of hedge fund-like, more speculative trading with publicly insured deposits was a problem, and they forbade banks from doing that in the Volcker Rule.
The mission of the Securities and Exchange Commission, from its own website, is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Seemingly contrary to that statement, Commissioner Piwowar argued that the SEC should not promote investor confidence.
Finally, I want to address the notion that some have said that the Commission should, quote, promote investor confidence, unquote. That's a nebulous concept, and in any event promotes the wrong incentives. Rather, the Commission, as I said earlier, should promote a healthy dose of investor skepticism.
Furthermore, Piwowar doesn't appear to be the best advocate for his own agency.
It seems to me that the whole point of the SEC and of the emphasis on disclosure is to reduce the losses by investors due to some underhanded or dishonest practice. Can you tell us, has the SEC reduced losses by investors over the history of its existence?
Excellent question. The answer to that question, I can answer in 3 words: I don't know.
Bottom line, foxes are guarding our financial henhouse when free market deregulators are in charge of creating and enforcing the rules that govern Wall Street. The attendance of CFTC and SEC officials at an event where speakers openly called for the abolition of the Federal Reserve, FDIC, and Dodd Frank legislation raises serious concerns. Also troubling is the notion that consumers should take on the sole responsibility of assessing a bank's risk. And tough luck on those who lose it all. Make sure to subscribe to the Undercurrent on YouTube for more independent, on-the-ground reporting. I'm Lauren Windsor. Thanks for watching. Get pulled in to the Undercurrent.
Undercurrent under the surface makes the mainstream